Last week we saw the S&P 500 have the best weekly gain in all of 2024. Notably, we saw companies like Nvidia up 16%, we had Tesla up nearly 10%, Amazon up 9%, and surprisingly we can see Berkshire Hathaway, one of the main losers of last week, down around 2.6%. Now, our key focus on today's episode is going to be looking at 4 undervalued dividend kings. And as a quick reminder for people on the channel, these are companies that have been increasing those dividends for at least 50 years or more. When we do talk about dividend aristocrat on this channel, those are companies that have been increasing those dividends for at least the last 25 years. Now, we also want to mention, just because a company is a dividend king doesn't make them special in any way. We have seen just over the last few years quite some notable companies that have unfortunately cut their dividend, as we can see VF Corp being one of them, and we also had 3M not too long ago. Now, we do want to point out one of the reasons why we do like to highlight dividend kings on this channel, because when we look at the historical data, those companies that tend to outperform are companies that continue to increase those dividends. And as we mentioned, 50 plus years of dividend increases is one strong sign, but as always, we should continue to monitor this. As we mentioned, it doesn't mean they will continue over the future period. Now, we'll also, if you stick around towards the end of the episode, talk a little bit about the KNGS Dividend Monarch ETF. This is one that tracks over 30 companies that are dividend kings, and we'll talk a little bit about that. Now, we're going to jump straight into it. The first one that we are discussing today is Johnson & Johnson, dividend king, which hasn't had the greatest performance over the last 12 months. It does have some litigation over their heads, and they are pretty much up only around 1% over the last 12 months. When we look at the performance over the last 10 years, again up around 53%. Bear in mind, this doesn't include dividends reinvested, and if we were to incorporate that, they still would have underperformed the S&P 500. Now, we do note it is trading now towards the upper end of the 52-week range. We get a double buy rating with a hold from Quant, and we can in fact see the PE does sit on a forward basis around 16.6. Bear in mind, for context, S&P right now around 23.5, and we can see the forward yield sitting around the 3%. Now, when we take a look at how they performed in terms of their earnings previously as well as expectations moving forwards, we do note over the last 4 quarters, they have beaten management targets, 100% track record, although they are anticipating 3 of the next 4 quarters to be negative year-on-year EPS decline. Now, what does it mean for December 2025? Ultimately, they're anticipating 1071, and we can see it will bring the forward P down, although marginally to around 15.5. Now, one thing that is very nice with this company, they have a very safe dividend score, 99, in fact the highest score obtainable, and we do want to point out they did increase the dividend just in April, 4.2%. Now, bear in mind, on this channel we want a minimum of 4%, and that is pretty much just to keep up in line with inflation. Now, what does it mean? Well, firstly, it was reaffirmed beginning of August. Ultimately, the dividend cut is highly unlikely. Now, for those that like looking at historical metrics, well, we're going to take a quick look at some of the Great Recession 07-09. Johnson & Johnson, no surprises, given they are a dividend king, did increase the dividend. They had above average growth, negative 6%. S&P during that time, negative 12. And for those that do also like to compare it against the total return, well, negative 27, significantly outperforming the S&P, which went down 55%. We can see here over the last 5 years, nice to report above inflation increases on average, 6% with a high single digit 8% over the last 20. And not only are they a dividend king, 61 years of consecutive increases, but they have been paying a dividend for over 100 years without a reduction. Very impressive indeed. Now, on this channel, we do like to focus on dividend yield theory. It does state a company is undervalued when the current yield sits above the 5-year average. So our first undervaluation signal today, although we do note the forward P of 16.7, not only not far off the 5-year average, giving reasonable valuation, but we can also clearly see pretty much in line with healthcare as a sector, sitting at 16.8. Then we move on to the first metric, the free cash flow payout. As always, below 60%. That just gives us faith that they can continue to increase the dividend and at a very healthy rate that we like. Pretty much over the last 10 years, around that 60% level, a little bit higher over the last 2, but nice to report over the next 12 months, anticipated to come down to 53. Hopefully we can see at best a mid to high single digit increase in next April. Then we look at the free cash flow. One thing we're looking for are consistent increases over the long term. Whilst it hasn't been very consistent, it has been increasing. 702 in 2023, a large increase anticipated over the next 12 months to 935. Then we take a look at the sales growth. For more mature companies like Johnson & Johnson, 3 to 7% is pretty much the ideal range. 3 to 4% at the lower end is a bare minimum, otherwise they're not even keeping up in line with inflation, which means in real terms their revenue is decreasing. Now we can see 2 of the last 10 years negative, but nice to report over the last full year sitting at that 6% level. And when we do look at it from the 10-year period and zoom out, we can see increases 74 billion to 85. As we said, very important just to keep up in line with inflation, because even if you do see it increasing over longer term, in real terms, if it's not hitting that 4% level, then it is in fact decreasing. One thing we've also noted, whilst they do return excess cash through those share buybacks, it is fairly trivial and don't expect any consistency. We do note some years where in fact it doesn't move at all. Then we move on to the ROIC. Very nice to note for Johnson & Johnson. It does look very healthy, above the 10% minimum we want to see. In fact, in the high teens, low 20s. And what I quite like to see with this company is the fact that it is very consistent. As I've mentioned in previous episodes, personally, I do like to pay a little bit more or a little bit of a premium for companies that can see that consistency through their numbers. Then we look at the operating margin, 12% or more, that is what we get. Again, consistency. What you won't get with Johnson & Johnson over the historical period are operating efficiencies. We don't see the margins increasing, pretty much around the mid-20 to upper 20% on a year-on-year basis. One thing we do see though, free cash flow machine consistently around the low 20s on the margin, always great to report, and we don't see any years where that number or metric has suffered. Then we get to the net debt to EBITDA, referencing the earnings before interest, tax, depreciation, amortization. This correlates to both balance sheet strength and dividend safety, and whilst we want to see below 3, it has been pretty much below that every single year, and the numbers that you see below, number of years it would take J&J to pay off all of their debt net of cash on hand, decreasing from the highs of 2017, 0.25 in 23, even an increase over the next 12 months. We can clearly see a very strong company, balance sheet does look very good, and in fact it is regarded as one of the best balance sheets globally alongside Microsoft. Then we take a look at this company's valuation. Now in today's episode, our value is coming to $184, and as always, how we get this, in our deeper dives we do run through every single one of these models. Today's episode we are getting straight to it, pretty much the average of these 3 models, and with the current price at 165, what we always like to do is run through a margin of safety. Now we use 10% and we execute on this if it meets our 3 criteria. Now those are a wide moat, strong financial metrics, and good forward-looking data. If you believe that in today's episode, well, we pretty much see J&J trading at this 10% point up to around $166. So really depends whether or not you believe this company does deserve more than a 10% or if 10% is justifiable. So in today's conclusion for J&J, a 10% MOS with Wall Street indicating 10% upside. Now, one thing you will get with this company just to think about is consistency over the longer term, as we have seen through those metrics and as we have seen through the dividend being paid out. For those that want to see what would a 15%, well, we see 157, at the 20% around 147, and at 25% around 138. As we said though in today's episode, 10%, and you can always grab a copy of this model by clicking on the pinned comment below to run your own numbers through, whether it's for J&J or any others. Now we also want to let you know we have just released our latest free weekly article. If you want access to this or any others, you can click on the pinned comment below, start reading straight away, and you can also grab a copy of the 25 undervalued dividend stocks that we have for your consideration for the month of September, where we also run through which ones sit within our own portfolio. Another spreadsheet that we have released are 22 of the dividend stocks which have the most upside in 2024, so again, do check that out by clicking on the pinned comment below. The next dividend king that we have is AWR, American States Water Company. Now, a fact with this, it is a dividend king, and it is the company that has increased the dividends for the most amount of years, as we will go on to show. Over the last 12 months, pretty much in line with Johnson & Johnson, very minimal movement, in fact flat over the period. Over the last 10 years though, this dividend king has outperformed the S&P, up 171%. Now it is currently trading at the upper end of the 52-week range. We do get a double buy rating with a hold from quant, and the forward-looking yield sitting around 2.24% with a forward P around 27.43. Now, when we do take a look at those earnings, what we do notice, the more recent quarter, they did miss, although marginally by 2%. The previous three, we see in line or a beat, so a 75% track record. Nice to report though, unlike Johnson & Johnson, the next 4 quarters, all positive increases to the EPS. And as we can see here, December 2025 will lower that forward P to around 25.04. Again, very similar to Johnson & Johnson, a 98 very safe dividend score and a very impressive high single-digit increase of 8.3% in August this year, so just literally a few weeks ago. Now, how did they perform in the last recession? Well, again, they increased the dividend. No surprises here. They had positive sales, plus 2%, and again, significant outperformance of the S&P. In terms of dividend growth, well, very nice to report, very consistently in the high single digit, 7% every single year over the last 20 years. And not only a dividend king, but we see 69 years of consecutive increases, making it the company with the most consecutive increases in terms of years. Very impressive indeed. Then we take a look at dividend yield theory, where we get the double undervaluation signal. The yield sits higher than the 5-year average, as well as the forward P sitting below the 5-year rolling of 32.2, although we do know it does sit much higher than utilities of 18, but as always, understand some companies do deserve a premium in relation to the sector due to metrics that will outperform. Now let's move on to the free cash flow payout. Again, this is one that we do use typically, but for utility companies such as AWR, it is a lot more volatile. So we look at the earnings data, below 75%, that is what we see every single year. 58 in 2023, 58 anticipated over the next 12 months. So it does look good. We should anticipate more increases like we have historically seen. Then we get to the earnings per share, looking very nice, nearly double over the longer term, and anticipated to continue that upward trend into the next 12 months. Then this takes us on to the EPS share growth as well as the sales growth. Ideally, we do want to see here around 4 to 6% year on year. We get that pretty much over the last few years. 10% in 2023, looking very strong. 12% over the next 12 months. Again, very, very good to report. But understand, with the utility company, it isn't a cyclical industry, and therefore we do note 5 of the last 10 years have been negative. Nice to report, though, the more recent year, 21% to their top line. And when we do take a look, very similar to what we did mention with Johnson & Johnson, with companies that you're analyzing, at least make sure they are keeping up in line with inflation. Now, interestingly, when we do look at utility companies in general, we do note they do dilute your position over the longer term, something that this company has done, but when we look at the net position, it is in fact a small reduction from 38.9 to 37.2. Then we draw your attention to the ROIC, which for utility companies, we do bring it down to 7.5, whilst it has been reducing over longer term, nonetheless looking very strong, 11% in 2023. Then we get to the operating margin, which we can see here in fact today. The first one with the operating efficiency, 26% in 2014, 33 in 2023. Finally, the net debt to EBITDA, the maximum we do increase to 5.5 for this industry. It has been increasing, so something just to bear in mind. Nonetheless, 2023 and over the next 12 months, around 3.9 to 4 still does look fairly healthy. But as always, something just to keep in mind when you are looking at companies. Again, it doesn't have to be this company, others in your watch list. So our valuation, and as always, if you are enjoying the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Our intrinsic value of $95 today is higher than the current trading price. So when we do run it through the MOS at 10%, a buy up to $85. At 15%, not there yet, but again, not too far off, around $81. So you could argue up to around 15% of MOS for a company that we do believe to be a very strong and consistent dividend king. We do, however, note that Wall Street do have a slightly lower price, 89 target over the next year, and they see upside of 9%. As always, do give us your thoughts. These aren't companies that we do typically review, so let us know if you do want to see more utility companies moving forwards. We then move on to Abbott Laboratories with another double buy from seeking out from Wall Street with the hold from quant. This one also trades in the upper end of the 52-week range and is up around 13% over the last year. Over the last 10 years, another one that has significantly outperformed the S&P, up 167%, although we do see all-time highs around $141 nearly 3 years ago. In terms of forward yield, well, 1.9% and a forward P sitting just below 25. And when we do look at their previous performance, well, they've done very well, 100% record over the last year. And again, moving forwards, looking positive. 3 of the next 4 quarters, double-digit EPS growth, with December 2025 bringing that forward P to around 22.65. Nice to report again, 3 for 3 in terms of very safe dividend score of 90, and also a nice high single-digit increase of 7.8% to the dividend in December 2023. Now, in terms of the last recession, again, no surprises, increased, positive sales, very nice to see, and one of the best recession returns we have seen on this channel, negative 13%. In terms of growth, not also very nice in the more recent year, but we also note over the last 5 years, they have been increasing those dividends 12% year on year. Over the last 20, though, we do note 4%, which at a bare minimum is keeping up in line with inflation. Now, we do see 52 years as it is a dividend king, but they have also been increasing those dividends for 100 years without a reduction. We also get that double undervaluation signal, 1.89 versus 1.67, as well as the forward P below the 5-year rolling. What we do, however, note, healthcare as a whole does sit much lower at 16.8, pretty much in line as we saw with Johnson & Johnson earlier. Then we look at the free cash flow payout, below 60% is what we see, although it does vary from year to year. 72% in 23, nice to see, 37%, so a nice drop over the next 12 months. Then we get to the free cash flow payout, where again we do see that consistency on a year-on-year basis has increased from 2014 and is expected to have a very large increase, in fact double from the previous year, over the next 12 months at $5.94. In terms of sales growth, well, this is pretty much a theme throughout this company, as we can clearly see the inconsistency on a year-on-year basis, as well as the drop to their top line of 8% in 23. Ultimately, we can see it has still doubled, though, from the 20 billion position in 2014. Unfortunately, this is the first one that we have seen that the net position over the longer term has been share dilution. So again, do factor that in. Maybe some of these things you could argue will take shape in terms of your margin of safety. ROIC nonetheless does look very strong, especially over the last few years, around the 13 to 16%. Remember, this does give us faith that Mandarin are able to effectively allocate their capital. Margins looking decent as well, at a bare minimum above the minimums, and in fact has been increasing 14% to 18 and 23, although we do note this has come down from the last 2 years. Free cash flow margin, nothing negative to report, looking very healthy, but again, year on year, there are some small fluctuations. Net debt to EBITDA looking very, very good, significantly lower than the 2.7 we see in 2017, down to 0.82, expected to go lower over the next 12 months, so no surprises, as well as the previous 2 companies we've reviewed, all of them do have a very safe dividend. Now, our intrinsic value of $130 isn't too far off Wall Street's 128, where they see 10% over the next 12 months, and in terms of a margin of safety, well, at 10%, this is where Abbott Laboratories is sitting around the 117 mark. For those looking at 15%, well, around 110, at 20% around 104, and those who want to see 25% around the $98 mark. In conclusion though, 10% MOS with 10% upside. We then draw your attention to BDX, where we see the most upside with a double buy and a hold from Quant. This one does trade in the lower end of the 52-week range, a yield of 1.62% and a forward PE sitting just below 18. Now, over the last 12 months, down around 12%. Over the last 10 years, up around 106%, marginally underperforming the S&P. We then also note over the last 4 quarters, the more recent 3 they have beaten by quite some distance as well. Nonetheless, 75% track record due to the miss in quarter 4 23. Moving forwards, nice growth anticipated, bringing down that forward P to 16.5 in September 2025. In terms of dividend safety, well, nice to report each of the 4 companies we've reviewed today have a very safe dividend score, although we do have to report pretty much an inflationary increase to the dividend in November last year. How they performed in the last recession, well, again, increased the dividend. They also had positive sales, and they also significantly outperformed the S&P, starting to look like a trend that dividend kings that we have reviewed in the past and on this channel have performed a lot better than the S&P during the last recession. We also note an inflationary increase over the last 5 years, but nice to report double-digit increases year on year if you have been a shareholder over the last 20, with 51 years of consecutive increases for the dividend to the shareholders. Now let's take a look at dividend yield theory. We get a severe undervaluation signal both on the yield as well as the forward P, which pretty much looks like the lowest it has offered over the last 5 years, as we can clearly see, average of 20.5, and this one, like Johnson & Johnson, pretty much bang on, spot on with healthcare sector at 16.8. Now, in terms of the free cash flow payout, what we can see, below 60% every single year, bar 2022, and from the highs of the 63%, it is down in 23 and expected to come down over the next 12 months. So we would like to see this November a very nice increase, a lot better than the 4% inflation. In terms of the free cash flow, well, again, inconsistency year on year, nonetheless increased, and again, a massive increase expected over the next 12 months. In terms of sales growth, well, 3 of the last 10 years have been negative, but again, we do see a lot of inconsistency. Some years, even back to back, have been double digits, which is good, but does make you a little bit concerned if we're not getting the consistency in terms of the expectations of what we should project moving forwards. Nonetheless, they have more than doubled their top line over the last 10, but they have also unfortunately diluted your position as a shareholder, and we can clearly see that from the graph. Moving on then to the ROIC, we want to see 10% or more, something they have struggled, something they have lacked with the majority of the last 10 years, consistently around the 6% over the last 3. And then when we get to the operating margin, we actually see the opposite of what we want. Whilst it is above the minimum 12%, the margins have been decreasing, something I would suggest to keep an eye on. Nice to report though, free cash flow looking fairly healthy on a year-on-year basis and anticipated 16% on a trailing 12 month. Then we get the net debt to EBITDA has been reducing from the highs of 2018, 2.21 in 23, pretty much there or thereabouts over the next 12 months. So no surprises, especially when we do consider the free cash flow payout, that the dividend does look to be very safe. Now our intrinsic value of $289, a little bit higher than Wall Street. They're 281. They see 21% upside over the next year. And when we do run it through the MOS, well, at 10% a buy at 260, at 15% at 245, at 20%, not far off, around $2 shy, so you could argue for BDX in today's episode, a 20% MOS with 21% upside from Wall Street and their expectations. Now, as we mentioned at the beginning of the episode, we do have a Dividend King ETF just to bring to your attention, and as we can see, the ticker symbol is KNGS. It is a fairly new one, and for those that do want to understand what this ETF is, well, ultimately it holds an elite group of over 30 companies that have 50 plus years of dividend increases. Now, they call them dividend monarchs, and essentially they are calling them the most well-known and established companies within their industries, so you get exposure not just to one industry in particular, but across a wide range, similar to how you would when investing in other ETFs. And they do talk about how this has some very defensive qualities, whilst you will be getting the upside of the market due to the fact that these companies, as we have seen through our own analysis, they don't have massive gains over the longer term. You will essentially, while seeing maybe smaller upside, also seeing smaller drawdowns, as well as lower volatility in the overall market. Now, in terms of what these companies are, well, the top 10, as we can clearly see, in fact, the top 3 are made of Kenvue. So we have the Johnson & Johnson spin-off, that is around a 5.6% weighting. And then we have Black Hills Corporation and Stanley Black & Decker. Now, you can go on this website and see all of them if you want to. Interestingly, Johnson & Johnson, one we did cover today, makes up around 3.5%. Now, when we take a look at how they've performed, well, they did close at $29.50. And interestingly, whilst this is one that has only been incepted very recently in November last year, we do note it opened around $25, which ultimately means right now, if you have invested from that point, you would be up around 20%, which is pretty decent over a yearly period. And as we mentioned, you would be susceptible to lower drawdowns and lower volatility. As always though, that is the end of the episode. If you have enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button so you are notified when we do drop these videos. And also don't forget to sign up to the free weekly newsletter. Grab yourself a copy, we have just released this morning's edition, and come and join us in the Patreon where we do run through our weekly buys and sells. As always, have a great day and we'll see you all on the next one.